Scott Chronert, U.S. equity strategist at Citi, joins us to break some things down. Your latest note, Scott, you talk about exhaustion is a word that comes to mind. What do you mean by that when you're talking about the markets?
Well, when you think about the way this year's unfolded, David, I mean, we went into the year with the DeepSeek issue confounding the AI narrative. We then rolled into the springtime Liberation Day tariff influence. Then we went into the summer months, had to deal with the deficit and a lot of the issues around that. And now as we've gone into this past couple of weeks, we've seen very good earnings with the Q3 earnings results, but not that much in the way of stock price follow through. You throw in the NVIDIA results last week, very strong quarter in the response. And, you know, our take on this was you step back and look at all this. It's been a really, really difficult year for many investors to navigate. Despite all of those issues, we're still up low teens. And so our view here is that we wouldn't be surprised to see many investors take this next holiday period to start locking things in for the year.
Yeah. Well, when it comes to the broader market in terms of value, do you believe at this point we're close to full value?
Well, the way we've been arguing, and we've got lots of different approaches here, is that we're using a 6,600 year-end target. We're right around that level going into today. And, you know, that's our approximation of fair value, looking at a number of different metrics, whether it's, you know, earnings growth over the next couple of years, a valuation assumption that's predicated on where rates are, and other metrics here. So we feel as if the market has already been discounting out your earnings expectations for some time. So from here, for the market to move materially higher, we need to see those future earnings growth projections continue to ramp. The good news is they have. Coming out of the Q3 reporting period and since mid-year, you look at 5-year earnings growth expectations for the S&P, and they have moved nearly a percentage point higher. So all told, we think things are in very good shape, broadly speaking. But that said, we're also just acknowledging that in shorter term, much of that is probably priced in.
With or without Fed rate cuts? I mean, the view is that they were just going to keep cutting here into some of this labor market weakness, and now that's completely being rethought. We were just having a debate about how sticky inflation numbers are. So
yeah,
do you need the rate cuts for the earnings picture to work?
Yeah, this is the linchpin into year end. So we're leaving the view open here that if you get that December Fed rate cut, that does play into our growth plus cyclicals barbell approach and does increase the odds for a bit stronger action at the end of the year. But, you know, the quid pro quo in this is going into the Q3 reporting period. Our view for Q4 was that we'd see volatility during the earnings reports because implied growth expectations were so high. We would then get that year-end rally to our price target, 6,600, predicated on an easier Fed. That's still, I think that's probably the right playbook from here, and that is that, yeah, a lot is being priced in and discounted and discussed around where AI is taking us structurally. But we've got the rest of the market action that's more beating to the tune of where economic trajectories are taking us. And in our view, the Fed should be cutting in December, and that does give you a little bit more room for a stronger finish to the year.